Hello, my name is Barry Wood, and I am the Assessment Division Director for the Indiana Department of Local Government Finance. Today we are going to talk about property tax deductions. We'll talk about definitions, including the Homestead Standard Deduction, the Supplemental Homestead Deduction, the Mortgage Deduction, the Over 65 Deduction, the Over 65 Circuit Breaker, the Disabled Person Deduction, the Heritage Barn Deduction, and environmental deductions. So what's the difference between a deduction, an exemption, and a credit? Basically, a deduction reduces the assessed value being taxed. An exemption excludes property from assessment and/or taxation, and a credit reduces the tax bill. For example, for an exemption, property that is not taxable may include churches or other charitable organizations. A deduction reduces the taxable assessed value of a property by a fixed dollar amount. This would include things like the homestead, mortgage, or over 65 deduction. A credit reduces the net tax bill by a designated percentage or prevents a tax bill from exceeding a certain percentage. One of the most common ones is the circuit breaker. In this example, the assessed value of a property is $90,000. The standard homestead deduction is $45,000. The supplemental homestead deduction is $15,750. The mortgage deduction is $3,000, and this person has a disabled veteran deduction of $24,960, resulting in a net assessed value of property of $1,290. If a taxpayer has the veteran deduction, it's suggested, but not required, that it be applied last. So if there is an unused portion remaining, the veteran can seek an excise tax credit. The homestead donated to a veteran deduction can be applied in any order, and it is possible for deductions to zero out a tax bill. Deduction applications must be filled out and signed by December 31st and filed or postmarked by January 5th. The Homestead Standard Deduction amount is the lesser of $45,000 or 60% of the gross assessed value of the property. It applies to the dwelling and those structures such as decks and patios attached to the dwelling and the surrounding acre. This applies to the property even if the taxpayer may not be there, although the taxpayer has the intention of returning after an absence. The applicant must be owning or buying under recorded contract the property. The supplemental homestead deduction is applied to the net assessed value resulting after application of the standard homestead deduction. The deduction equals either 35% of the net assessed value, if that is less than $600,000, or 25% of the net assessed value, if the net assessed value is greater than $600,000. In order to claim the homestead deduction and the supplemental homestead deduction, the taxpayer must complete the form prescribed by the Department of Local Government Finance. It is filed with the county auditor's office where the homestead property is located. Only one individual or married couple may receive a homestead deduction for a particular homestead in a particular year. The sales disclosure form may also be used to apply for deductions, including the homestead deduction, solar energy, wind power, hydroelectric, and geothermal. The homestead deduction applies to a dwelling and up to 1 acre surrounding that dwelling, even if that acre straddles or overlaps more than one parcel. The state law does not require a taxpayer to combine the parcels in order to receive the deduction on the 1 acre. Also, the property must actually be receiving a homestead deduction in order to receive the 1% circuit breaker or tax cap. The mortgage deduction must be applied using the form prescribed by the Department of Local Government Finance and is filed also with the county auditor's office where the property is located. Applicants must be residents of the state of Indiana. That must be filed during the period specified. Once the application is in effect, an application or other filing is not necessary unless there is a change in the status of the property, such as a refinancing of the property. It also must be filed by the due date of December 31st and received by January 5th. The mortgage deduction equals $3,000, one half of the assessed value of the property, or the balance of the mortgage or contract indebtedness, whichever is least. Only one signature of a spouse or married couple is required for filing when the owner is a husband and wife in tenancy by the entirety. A contract buyer must submit a recorded copy of or recorded memorandum of the contract. A person is not entitled to the deduction unless the person has a balance on their mortgage. Another deduction is the over 65 deduction. Again, in order to claim this deduction, a taxpayer must fill out the application prescribed by the Department of Local Government Finance, and it is filed with the county auditor's office as well. Applicants must be residents of the state of Indiana, and as true with all the other deductions, it must be filed by December 31st and postmarked by December 31st and received by January 5th. The applicant and any joint tenants must reside on the premises. If a taxpayer is absent from the property, for example, if they are in a nursing home, that will not prevent that person from receiving the benefits of the over 65 deduction. The applicant also must have been the owner or contract buyer at least 1 year prior to claiming the deduction. In determining the assessed value, the annual adjustment or the trending process will not prevent that amount from being considered. If, however, there is a change in through the cyclical reassessment process, that could be considered for eligibility of the over 65 deduction. Beginning in 2020, anyone who first applies for the over 65 circuit breaker credit must have a total assessed value for all real property that is less than $200,000. However, for any individual who receives the over 65 deduction before January 1st, 2020, the assessed value limitation is only applicable to the homestead property. Also, the amount has been increased from $160,000 to $200,000. In order to qualify for the over 65 circuit breaker credit, the individual must receive the homestead standard deduction, and the individual must qualify for the homestead during the current year. The individual is 65 years of age on or before December 31st of the immediately preceding calendar year, and the individual has an adjusted gross income for the 2 years immediately preceding of $40,000 for joint filers or $30,000 for single filers, and the assessed value is less than $200,000. To receive the over 65 deduction, the applicant received no property deductions other than the mortgage deduction, the homestead, and the supplemental homestead deduction, and the fertilizer storage deduction. For the over 65 deduction, the applicant may be a surviving unremarried spouse and at least 60 years of age on or before December 31st. The surviving spouse must otherwise satisfy the eligibility requirements for the deduction. There is a disabled person deduction, again, filling out the application prescribed by the Department of Local Government Finance, and it is filed with the auditor's office. The information is confidential. The maximum deduction is $12,480, and the applicant's taxable gross income cannot exceed $17,000. Like the over 65 deduction, any increases in the assessed value based solely on the annual adjustment or trending process is not to be considered for purposes of determining whether or not that person is eligible for the disabled veteran deduction. The Heritage Barn deduction is applied by the taxpayer with the county auditor's office again by December 31st. It must be postmarked and received by January 5th. In order to be an eligible applicant for the Heritage Barn deduction, the person must be the owner or purchasing on property under contract. A heritage barn means a barn that on the assessment date was constructed before 1950 and retains the sufficient integrity of design, materials, and construction to clearly identify the building as a barn. And it is also of mortise and tenon construction, which is using heavy wooden timbers joined together with wood peg, mortise, and tenon joinery to form an exposed frame, structural frame. The barn was designed to either house animals, store or process crops, store and maintain agricultural equipment, or serve as an essential use for purposes related to agricultural activities. A county fiscal body may adopt an ordinance to require a person receiving this deduction to pay an annual public safety fee of no more than $50. There are certain environmental deductions, again, applying through the department's application form filed with the auditor's office. Those include geothermal and hydroelectric deductions, as well as solar energy and wind power devices. The maximum deduction amount for a solar energy system equals the out-of-pocket expenditures for the components and labor involved in installing the components. The maximum deduction amount for solar power device is the assessed value of the property less the assessed value of the property without the device. If you have any questions, please contact us at the following information. Thank you.